Thank you, Brad. Well, I'm glad to be in Germany. I even got a pin, the United States-Germany pin. I might have gotten two of them. I'll take one back to my kids. Thank you for including me. So Brad said, John, no marketing, be efficient, and don't put too much on your slides. So I had to make some notes to cover some of the material, but I want to make Brad happy because I want to be invited to be back. So Brad mentioned the multifamily residential market in the United States. We say apartments often, so I'll use apartments a lot, but essentially the same thing. So to give you some context on the United States housing market, so it was mentioned earlier, the United States population is somewhere 320 million, 325 million. There are roughly 118 million occupied housing units in the United States. Of those, roughly 64% are owner-occupied, which I think is significantly different maybe from Europe or certainly from Germany. 64% are owner-occupied, and about 36% are renter-occupied. So of the rental units, about 42% are apartment buildings with 5 units or more, so more professionally managed, larger apartment communities or apartment complexes, we might say. So in total, the total U.S. housing market, rental and owned, roughly 15% of the housing market is in this category of 5+ unit apartment communities. And that's essentially what I'll be addressing today. So to give you some context, I'll give you just the pictures. In the U.S., we say low-rise, mid-rise, high-rise. Low-rise, oftentimes we say garden-style communities. Generally, low-rise or garden-style communities are 2 to 3 levels. Mid-rises kind of 4 to 7, maybe 4 to 8 levels, and then high-rises 9 or more levels. You have subsidized apartment and non-subsidized apartments. So subsidized meaning the government as some type of municipality limits or determines what the rental rate will be, versus non-subsidized, we also say conventional or market rate apartments, is where the market dictates what the market rent will be. And that's mostly what the U.S. investment market is focused on, is the non-subsidized or the market rate apartment sector, and that's what I will focus on today. So like any other sector, the fundamentals in the apartment industry are driven by demand and supply. In the United States, it's been a big demand story in the apartment sector. So as you might guess, younger adults have a higher likelihood to rent. So this chart here shows you of each age category, what's the percentage likelihood that they rent. So as you can see on the far left-hand side, the 18 to 25-year-olds generally have, historically at least, had about an 80% likelihood that they will rent. And then when you go to 25 to 29-year-olds, over 60% typically rent, and then on to 30 and 34-year-olds, typically roughly around 50% rent. So yes, there are a lot of people who rent throughout other age groups, but by far this has been the driver of the apartment demand in the past 5 years in the apartment industry. So why is that important to us today in this discussion? Well, as you know, there are a lot of these people. So millennials or echo boomers, as you can see, are in the green. This is essentially all the age groups going from less than 5 up to over 85, and this kind of shows you how many people there are in each age group in the United States. This green bar is the millennials, the echo boomers, the Generation Y, whatever you want to call them. There are a lot of them. So this generation, the millennials, is the biggest population generation in the United States ever. There's never been an age cohort as big as the millennials are. And a lot of them are still in college and just now getting into college. And as we mentioned in the previous slide, they have a higher likelihood to rent. And it's been touched on a little bit previously. Why is that? Well, they're waiting later in life to get married. They like the flexibility. They like to be transient. They have an enormous amount of student debt. So there's some drivers of that that are driving them to rent as well. So I thought this is an interesting chart. So historically, roughly 12% of these young adults have lived at home with mom and dad. Maybe some of you have some of these young adults living with you. Today, we're at a record high in the United States of over 15%, or roughly 15%, are living at home with mom and dad. So that suggests, and we would submit, that if the economy continues to improve, maybe some of these young adults will go out and get their own apartment. However, as we discussed, they have a lot of student debt. So it's been projected that over the next 5 years, this year included, but through 2021, roughly 5.6 million households, new households, will be formed in the United States. Research suggests that roughly half of those will go rental, and the other half of those household formations will go ownership, and that's obviously a 50% ratio versus historical average of closer to 34%. So a lot higher percentage of the household formations today and into the next 5 years are projected to go to the rental sector. Within rental sector, it's suggested that roughly 45%, which is consistent with historical numbers, will go the apartment route versus the single-family home rental route. So all that suggests that over the next 5 years, there'll be demand for about 1.25 million new apartment homes each year well, not each year, but total to be built, which would be around 250,000 units per year of needed new apartments in the United States to meet the demand of the growing household formation. So that's on the demand side. Now we'll shift over to the supply side. So this chart shows you 50 years of annual apartment completions in the United States. So the green bars are the actual completions by year, and then the gray bars are projected completions by year. So you can see over the past 50 years, the U.S. has averaged roughly 334,000 new apartment unit developments units developed each year. And you see in around 2010 to 2014 was a 50-year low of new supply. So even though we had all the demand fundamentals that I mentioned earlier, a lot of the millennial demand, we weren't building the new apartments to meet the demand. Well, developers figured that out. Capital figured that out. So capital has flowed to build new apartment supply. And they've built it, and it's obviously been robust growth in apartment supply. It's projected to peak in late 2017, so later this year, or perhaps early next year. And then it's projected to tail off from there. It's been mentioned a couple times that labor is getting far harder to secure to build communities. The cost is going way up. So it's my hope that the supply will continue to drop. But to be fair, there has been some headwind of new supply, but it varies by market. As mentioned in the previous presentation, the U.S. is a very large and diverse market. So it's market by market, and it's even sub-markets within the markets. So some sub-markets within a market are getting too much supply, and within the same market, a different sub-market may have very good operating fundamentals. So it varies pretty significantly by market. A lot of the new supply has been built in the urban core areas. A lot of the millennials want to be in the walkable urban areas, so that's where so much of the supply has come. And that's where some of the rental growth headwinds have occurred in some of the urban core markets. So because the fundamentals, the operating fundamentals and the demographic fundamentals have been so strong, a lot of capital has flowed into the sector. So it was mentioned earlier, Bob mentioned some of the capital flows that the transaction volume in the apartment sector seems to have peaked in 2015 or 2016. This chart shows quarter by quarter transaction volume, and then the cap rates is the gray line. So obviously the capital has flowed to the sector driven by the great fundamentals. And so it's projected 2017 will be another down year for transaction volume. This is just a breakdown of the buyer composition. As you can see, it's a very diverse buyer pool in the apartment sector. Maybe surprisingly to some that so much of it is dominated by the private buyer. Maybe some of that is driven by financing ability. So a lot of leverage has been available at very cheap costs. So the private buyer has steadily grown their participation in the apartment market. So not surprisingly, all this capital has flowed into the sector because it's historically, over long periods of time, apartments have outperformed. So relative to other asset classes, apartments, whether you look at it since inception of tracking of NCREIF, which is a benchmark for returns, since 1978, or if you look at the past 25 years, apartments have outperformed and with limited volatility. So historically, over long periods of time, apartments have been a great sector to be. So again, in conclusion, favorable liquidity, the large, diverse buyer pool, as we've talked about, attractive financing. A lot of the lenders are very attracted to the sector, and whether it be life insurance companies or banks or securitized lenders, CMBS, or Fannie Mae and Freddie Mac, the agency lenders, there's just a lot of diverse lender interest in the sector, and it's driven by the stability of the sector. So, historically, the sector has had very stable cash flow. We have a diverse tenant mix. So at our company, we manage roughly 60,000 apartments across the U.S. That's in roughly 200 communities. So the average community size is roughly 300 apartments for us. Again, that's our portfolio. And so you obviously have 275 plus different residents, so this is less concentration risk per tenant. So and typically we're doing 12-month lease terms. We have 6-month lease terms and 9-month lease terms. You generally pay a premium if that's your lease term, but overall we're usually doing about 12-month lease terms. And that is what's driving interest from both equity and debt, is a heavy focus on the stability and the current income driven by the apartment sector. And then lastly, I'll just say going forward, demand is expected to continue to be strong. I know so much of the story has been on millennials and the rentals, and yes, I do agree, at some point many of them will want to buy a home. However, I'd submit, as you may know in the US, it takes 10 to 20% down payment, cash, to afford a home. So I think a lot of them are going to struggle, and they have a lot of debt. And so many of these millennials are still in college. So I think the demand story is projected to continue for another 5 to 8 years at least. So the demand story looks great. I'd say, to be fair, supply has been over long-term averages. Hopefully it will continue to come down, but it's pocket by pocket. But it is slowing supply. I'll tell you, for us, for rent growth, we were having, say, 4 to 7% rent growth per year for the past several years. Now it's projected to tail off to around 2 to 4%. For our company, for our 60,000 unit portfolio, last year, 2016 versus 2015, we had a little over 4% revenue growth year over year. We're budgeted this year versus last year to be 3.2%, so a little over 3%. So a decelerating pace of growth, but certainly still growth. So overall, we would submit that it's a positive outlook. I'd say short term, you got to pick your pockets and know where you're buying and how and why you're buying there. Long term, though, I would submit, research would submit, that the sector still looks very, very favorable given the strong demand and supply fundamentals. So that's it for the apartment sector. Thank you very much.
Thank you, Jon.